Good morning. Happy Monday. Welcome to this week's version of the Brew. On Monday, we like to have our good friend Matt Cashman from the OIC with us. He's joining us today. We're going to tee up 0DTE again. We're going to get Matt's perspective on this. We chatted about it a little bit last week, but we're going to take a little spin with Matt and 0DTE. So stay tuned for that opening bell. Ding. Hello, Matt. How are you, buddy?
I'm doing really well. How are you guys?
Good. Hi, Mal. Molly, you're muted.
Nice work, Molly.
Yeah. They muted you. You know why, Mal? Because you're not really here. You're
It's great.
That's not.
I'm
really
a clone.
You, right?
Yep.
Yes.
It was too early, so I hired a clone. I bought one.
Good job.
Yeah.
All right, Matt. I'm not going to talk about any sicknesses you have at all. I swear.
We will not mention that.
I will not mention that you might have COVID. Wait, did I just say that?
Well, that's
so. Just don't look directly into the TV because we
don't
just
sneeze on me either.
Yeah.
The beautiful part about remote work is that like I can be on the tail end of COVID and still go to work. How about that?
You're amazing, Matt. Just a round of applause. Thanks
That's
for
right.
coming and joining us. That's amazing.
Very good.
Yeah.
All right. So, Matt, we're going to talk 0DT. By the way, 0DT for you and me from the trading floor days, we had, that was called Expiration Friday, 0DT, right?
Yeah, exactly.
How did you like, I wanted to ask you this, I was thinking about this over the weekend. I want to ask you, did you like trading on the day of expiration, or was that not your favorite? I mean, I have an answer for this, but what are your thoughts on that?
I think from the market maker's perspective, it has two elements to it, right? The first element is that it's in some cases exhilarating because, and we'll get into this as we discuss 0DTE from the perspective of like how time affects options more generally, but like as options get closer to expiration, they become more sensitive to movement. And so when you have these big, massive positions that you can't get out of from a market maker's perspective, you would have, 1,000 calls on a line. Well, that makes a huge difference if the stock goes through that strike, whether you're long or short them. It makes a giant difference in your P&L usually. And you just had to understand how to manage them. And so you were constantly making these like risk management decisions, coin flips as to like whether or not you thought something was going to happen, and being able to kind of handicap whether or not movement was going to be large enough to get two strikes that you had in your inventory. And so that part was kind of exhilarating, right? Like you always had the potential to make or lose $1 bazillion on expiration because of the fact that it's such a kind of binary event. But then on top of that, you have all of the headaches that come with the risk management from that happening and it being a binary event because of the fact that if you made or lost a bunch of money, you don't have any more price iterations to get it back, right? That option's just gone and it becomes a cash event instead of a event that involves optionality. And so that part was really difficult. So, I mean, it's kind of like a double-edged sword for me. I was good at trading expiration. So usually I made money on expirations, but it was something I had to learn, Yeah.
Those are good points. I think, I was listening to, I was watching something from Sosnoff the other day, and he loved 0DTE, the day of. He thought he was really good at it. I think I agree with you generally. I probably prefer not to be trading them. I think you're right. We market makers did very well on those days. Look when people are hitting our bid and taking our offer, we're loving life a little bit.
Right. Yeah.
So that helped out, and there was a lot of activity too. So you tended to get some decent two-sided paper, people closing things down, rolling things out. That was always fun. And I think that's where I probably made, my share of the money on the 0DTE days.
Yeah.
But I would say generally though, I probably didn't like the binary kind of outcome sort of situation. If I get short a ton of gamma on a line and all of a sudden some news comes out, and inevitably it came out on that day, Right? I
Yeah.
don't know how they figured out my position all the time. You get these
So
monster moves. Yeah,
and
it kills you.
just to interrupt you. So why don't we take it back to the beginning, because we looked at we have some questions coming through, and it turns out we have actually some teenagers watching. So
Yeah.
we have both expert groups and we have this really young demographic trying to get in. So what is DTE, zero DTE?
Let's talk.
Days
Yeah.
to expire.
Let's talk. I think there's two parts to this discussion, right?
Okay.
I think the first part is the more general part about optionality and what happens when optionality and time comes out of options, right? So a zero DTE option is basically just an option that is expiring that day. What Lex and I were talking about is that, like, way back in the day, option expiration was only every third Friday of every month.
Mm-hmm.
So we only had expiration. We had zero DTE options, but they were only once every 30 days,
Right.
basically, right? They were on
Huge
the third
buildup.
Friday of every month. Yes.
Yeah.
And so you would have this massive buildup of positions and, inventory that you had to kind of like move around. But the interesting part about it is that as time has gone by,
You get weeklies.
you get weeklies. Then you get Mondays and Wednesdays. Then you get Tuesdays and Thursdays. And now we have an expiration that happens every single day generally in the indexes, right?
Yeah.
And the way that happened was in 2005. And Lex and I, right, I don't know, Lex, were you trading options in 05 still? Or were you?
Yeah. No, I moved off floor right around then to manage our entire book, to help in the trading room. Yep.
So up until 05, there was just the third Friday of every month. And then weeklies got listed in 05. And I remember being a market maker in 05 and pushing back against weeklies and saying, like, this is going to really complicate my book. And I'm going to have to manage a whole lot more risk, a whole lot more strike risk, a whole lot more just like notional risk on a weekly basis. And a lot of people were with me and pushed back against it as well. Well, the weeklies came out. And so weeklies start trading, right, in 05. Then in 2016, they list Wednesday weeklies in the indexes. At the time that they listed Wednesday weeklies in the indexes, this is a really interesting fact that I think is really important to build into this conversation that most people don't talk about. Mm-hmm. Weekly expiration options constituted 35% of SPX volume already at that point in time, by the time they were just listing Wednesdays. Mm-hmm. So they list Wednesdays in 2016. Wednesdays go so well that now they have Mondays, which get listed in 2016 as well. Still, 35% of option volume was on a weekly option in the SPX. Mm-hmm. Then fast forward to 2022. In 2022, they list Tuesdays and Thursdays, which rounds out the cycle of now you have a Monday, Tuesday, Wednesday, Thursday, Friday expiration. At that point in time, this is a really interesting fact, 72% of the index volume from the previous year was a weekly, quote unquote, a weekly option.
Okay, so tell us the benefits. Why the migration?
Well, here's the interesting part about it. A lot of the rhetoric that you hear right now from people, from a lot of talking heads about this, is a lot of people being really surprised about the fact that, 3 out of 4 or 2 out of 4 trades are weekly trades, and that volume migration is a big deal. And the fact of the matter is, it's been that way this whole time. Like, people like to use these options because A, they are generally less costly because they have less time in them. Time is always a part of an options valuation, and the less time that it has, generally speaking, the less value it has from a notional perspective. So they cost less, right? That means that you're expending less capital. You're getting less coverage from a time perspective, but you're expending less capital to cover whatever you're trying to cover. So that part is really advantageous, or people perceive it as advantageous from the retail side of things. Now, the other part about it is that it has inherent in it the same kind of leverage that any option does, which is if it goes through your strike, you start to your position changes drastically on the day of expiration if it goes through one of your strikes, because the delta of that option goes from 0 before to 100 pretty fast.
Mm-hmm.
And what that is the actual Greeks of that option and the way that the Greeks of that option work on the day of expiration. And that's the more general concept of like how these options work, which is when you pull time out of an option, the Greeks of that option change significantly.
Mm-hmm.
And it
Wow, that's
becomes
interesting.
much, much more sensitive to underlying movement. And
Right.
so that's part of the reason why people love them, is because they cost less and they still maintain the same leverage that exists within an option. It's just you get less time coverage for them. And that's the reason why they cost less.
So what
Wow.
what are you thinking then? I know what the market maker has to do. The market maker responds to quotes, right? He buys, he sells. He or she or it isn't really reaching for anything unless they have a really risk management problem, right? So dealer, market maker, they're in a box over here. They're just responding. Who's using this product? So it's so popular. Got to be retail. I understand that. We're going to talk about them in a sec. Institutional probably on the ship as well, I'm imagining. And what are they doing? Are they selling these zero DTEs every day of the week, trying to harvest premium? That's a drinking moment. Drink up.
When I'm going.
Yeah, we're harvesting theta. I don't have my glass again. Or is it something else? Because I'm going to read you an interesting statistic from Mandy at SIBO about the gamma position of dealers, and it's actually really, really small relative to the total notional of what's trading in zero DTE. So dealers aren't getting stuck with this nasty negative gamma. It doesn't seem like. So, it sounds like retail is tossing one out there in the morning, trying to buy it back by noon, 10:30, whatever, take a little harvesting of theta into their account, and then
hydrating.
And then moving on. I mean, tell me where I'm wrong. I mean, I could be very wrong, but what's going on with these folks?
I don't think you're wrong. I think so. First of all, I think it's really hard to tell who is using them. If anyone can tell us who is actually using them, it's going to be the exchange,
right?
Because the exchange knows where all these orders are coming from. There's a lot of people trying to surmise who is using them and doing that by slicing up the data as to the size of the trades that are happening and saying, oh, if it's a one lot, it must be retail, or oh, if it's a two lot, it must be retail, and trying to do that and tag that as a retail trade to be able to tell who's institutional and who's retail. Mm-hmm. The problem with that is that I can't tell you the number of times I traded a 10,000 lot one at a time with an iceberg order.
Yeah.
Right. It's like you can't tell who's institutional and who's retail doing that.
Right.
Now, with that said, there's been a couple of different people that have put some really good data out there about that, taking into account the fact that they can't really tell. And one of the guys is, I forget what the guy's name is. He was on Odd Lots, which is a Bloomberg podcast, mm-hmm. right, with Tracy Alloway and Joe Weisenthal. He was one of the first people that came on that really presented an idea that was pretty good, which is it feels like what's actually happening is that people are buying these things on the retail side. Mm-hmm. And what you're getting is on the market maker side, you're getting people selling them and then actually dicing up their risk. Because when you think about the retail side of things versus the market maker side of things, if you were to really design this in a risk averse way, mm-hmm. the person that you want to have the massive short position is probably the market maker, because the market makers are better at being able to slice and dice up their risk and mm-hmm. cover their risk, right? And so if you were to design it that way, in a way that you didn't want to have some market changing event, you're going to want market makers to be holding the short side of things. And that's the way that it looks from the outside, like it's lining up. Like market makers are actually taking the short side of the bet. But what's actually happening is that they are probably really good. I know that they are really good because that's their business, at being able to go and hedge that risk in 17 different ways in 17 different products, right? Mm-hmm. Like that's what they end up doing, is they take on this short risk and then they slice it up and dice it up and go cover it in lots of different quantitatively, financially, mathematically ways, mm-hmm. right? They've figured out. And so that's why you get this, like, they're short, but they're not really short from a fully notional, like relative to the notional amount, they're not actually short a bunch of gamma.
Yeah, so that makes sense. And I can read you some numbers from SIBO real quick.
Yeah.
They're saying that the net gamma exposure from these dealers is between, on the low end, 170 million, and I'll put it in context.
Okay.
On the high end, 670 million. This is gamma, okay? Yeah. In a product that trades 400 billion notional. So it's like 0.04% to about 0.17%, their gamma hedging problem. It's a minute number, relatively speaking. So it's and her point is it's hardly the tail wagging the dog here with gamma exposure, which to me was a shock. I didn't know that. I thought it would be way more.
Well, here's an interesting part about that is that they're comparing it. There's two parts to that also, right? They're comparing it to full notional value. And if you think about gamma as in a relative way to full notional value of options is going to be more centered in options that have longer terms, right? They're going to be bigger, fatter options because they have more time in them. They have more vega in them. So they're going to be more expensive options. So when you take gamma exposure from a notional perspective and you compare it to full notional value, is it apples to apples? Is it not apples to apples? I'm not going to weigh in on whether or not it is. I'm just saying bigger options have more notional, smaller options have more gamma.
Right.
Can you compare the two of them? Sure. Yes. It's not always a perfect comparison. But the other part of it is that they are counteracting some of the narrative that I was talking about before, which is that people are talking about the fact that this is like this, mind-blowing thing that is happening that is changing the options industry. And from an educational perspective, most of the time when I talk about this, I tend to take the opposite side of that narrative, which is it's not that controversial and it's not that mind-blowing. It's just that the exchange makes money on volume. And if you look at the numbers that I gave you about like when they rolled out Monday, Wednesdays, the last year, 72% of their volume came from weeklies. What do you expect them to do? Right? I mean, they're going to keep doing that. Like the volume, the exchanges chase volume. That's just the way that it is. That's how they make their money. It's the same way in the brokerage world, right? Brokerages do the exact same thing. And so from my perspective, to have the conversation about like, oh my God, this is going to change the way that options are traded and it's going to create some like systemic risk event. It's like, why don't we change the narrative to be like, how do we manage the risk of these options? Because the risk of the options is what needs to be dealt with, not whether or not they exist. The exchange is in charge of, one of the things from the OCC's perspective is that the exchange is in charge of what options get listed, how they get listed, what strikes get listed, what series, the exchange does that. Now they have to get weigh-in from, if they're going to do something like add Mondays and Wednesdays, they have to get weigh in from the SEC and they have to get regulatory oversight on it. Right. But they're going to list what they're going to list. Our job from a risk management perspective is to say, okay, how are we going to think about these? How are we going to manage the risk that they create theoretically? And so I take issue with the narrative of like, this is going to create some systemic risk event because if we're going to be talking about that, we're talking about the wrong thing. We need to be talking about like, how do we manage the risk that these create? Right. Not like whether or not they should exist, because the cat's already out of the bag, right? Like, what are you going to do? You've got an exchange that's doing 72% of their volume in weekly options in a year. Like, what, you really think that you're going to be able to roll that back? I just don't see it happening.
Right. Yeah. So you're not buying into the fact or the opinion that these zero DTEs are exacerbating SPX volatility or suppressing it for that matter. I mean, it even though they trade so much, it sounds like we don't have that problem, at least yet. I don't see it yet. Maybe I'm missing something. I don't know.
I think it's equally as likely that they're exacerbating as the fact that they're dampening volatility, to be honest with you. And from my perspective, the way that it looks like the numbers are lining up, it looks like if the person if there's one person who has a short position, it looks like it's on the market maker side. And if I were going to design this in the most risk averse way, I would want the market makers to be the ones that have the short option position. That's all there is to it. From my perspective, if you're going to, you want the short option position in the strongest hands possible. And those are the strongest hands. And they also are they're just better at hedging because that's what they do for a living, So that's my perspective on it. I think a lot of it is overblown and that people are looking for reasons.
Yeah.
Right. I mean, the other part about it from my perspective is that we're always trying to explain this random thing called the market, right? Everyone's always trying to figure out, like, why is it doing what it's doing? And the real fact of the matter is, I think we don't want to believe that it's just purely random.
Right.
We're always trying to find reasons why it does what it does. And so this, I think right now happens to be one of the, reasons du jour that people like to talk about. But,
sure.
Yep.
Well, go ahead, Mom. Sorry.
Yeah, I like to zoom out. So if, you on one aspect, you have the SEC looking at gamification and all that happened and occurred, and with, the GameStop scenario, and this movie's coming out pretty soon, so we're just talking about it. But so I see, if I zoom out, I see SEC, the big guys were holding the shorts in that scenario. And when COVID hit, and we're just going to mention that because you are
Matt's might
battling with it. Yeah. So when COVID came out, everyone jumped in and started trading for the first time, and a lot of millennials, 50% of the Gen I was millennials. And so their method was more of a value trade. And so, with the weeklies and, SIBO coming out with nanos, and they only do weeklies, it's cheaper, it's more flexible, you can manage it, it's less risky. They're just cheaper to get into. It seems that would make it safer. But then, because this saga that happened, they lost almost 7 billion, and then some. That's just the low end. My question is this: is the SEC kind of pushing the retailers out, saying it's more volatile, to have them involved, and under the auspice that we're going to keep them safe, when really, when you have these retailers coming in, and especially young ones, they tend to be more value traders, so they're in it for the long haul, and they're dealing in weeklies, which seems to be safer, cheaper, and better for them. What do you think on that?
So your question is whether or not the SEC is trying to push these people out by stopping the trading?
No, I don't see how. So when you read their releases, the SEC releases, they're protecting the retail trader because they believe that it's increasing volatility in the market. Have you seen that?
Yeah.
So I see that having young retail traders coming in that are more value traded, they really like this. They've done their research. They've taken a bite out of, the company. They've used it. I see that they're less volatile, especially, playing around with weeklies and what do you think about that? It just seems to be two different narratives kind of colliding, and when we zoom out, things seem to make more sense when you're looking at, wow, these big guys might have lost a lot of money, and so how can they mitigate that in the future?
Yeah, well, I think I'm going to answer that question from my seat, which is always going to involve a certain amount of education, right? Which is like, I think the part that you mentioned in that explanation, which I think is most vital to that situation, is the part where you said, they've sat down and done their research and know what they're doing, et cetera, et cetera, et cetera. Mm-hmm. From my perspective, I think those are the people that should be using these options, and that should be using options in general. And what I do on a daily basis is trying to kind of drive that message home all the time, which is, you need to understand the basics of optionality in order to use these products in general but also most specifically, if you're going to deal in options that have very short time horizons and that involve very small amounts of price iterations before they settle, you need to understand how the math works behind them, because you've only got 3 or 4 shots at like making it work.
Yeah.
And so you need to understand your risk. And so when you say that those kinds of things, I think the thing that I automatically think, and I might be talking my own book because I'm an educator in the option space, but I always think about it from the perspective of like, if people really understood how these options worked, we wouldn't have issues about this, right? They would understand what their risk was.
Yeah.
And so, there's a chicken or the egg situation here, which is like, can you force people to understand how options work before they're allowed to enter into the marketplace? Technically speaking, before you trade options, you are supposed to read the options disclosure document, which is a giant document that's produced by the OCC.
Have you read it?
I have read it.
I did too. It was scintillating.
Yes.
I loved it.
It's a document that was created a long time ago and has had lots of kind of add-ons to it over the years. There is an idea that it could theoretically be simplified coming soon, hopefully.
Matt's rewriting it, by the way.
Exactly. Hold on a second. I'll be right back. No, but it I don't know. From an educational perspective, I want people to understand how these options work before they start using them. And from a regulatory perspective, you're supposed to read the ODD before you trade options. And they put it up on the screen, and at any brokerage, before you trade options, you have to click that you've read it.
Mm-hmm.
Do people actually read it?
I'm going to go out on a limb and say no.
I don't know if they actually read it or not. I'm not sitting at their computer screen watching them.
All right.
However, my job is to kind of fill in the blanks in those situations and be able to say, listen, like, this is how these things work. And so
I think,
go on.
Especially with options. I think, SEC might have a point if it's pure speculation, but with options and you have protected puts and all these really great tools to protect yourself and mitigate loss. And
let me pile on that concept too, Molly, because it's a good one. What I think we see on our end, and our end now is, at least my end now, is the retail side, right? Most of the folks I interact with are more complex spread sort of traders in the retail side, at least what I see, which means that they've got a long and a short in the strategy. So these retail folks really aren't selling a naked straddle and doing one of these at the option altar, hoping that thing decays to death. That isn't really happening. Now, they might sort of do that with an iron condor and buy the long side so that their defined risk is capped, right? And it is defined as opposed to undefined. So we're not seeing a lot of retail folks just getting up there and saying, woo, let's go sell these straddles and strangles and naked and just be bam, let's rip it. I don't think we see a lot of that at all. Additionally, the way margin works and the way the rules work with the retail side is you probably can't do that anyhow unless you have a ton of money in your account, right? And you can cover those shorts, which is an option level 6, I believe. Don't quote me on that. I'm not supposed to know those answers, but something like that allows you to sell naked options, and you still need a lot of money to do that, right?
Yes, absolutely.
And you're not going to sell a lot of them either, even with a lot of money. So anyhow, I think the retail side is probably pretty much capped. Now, can you lose? Of course you can lose, right? You can lose on iron condors, you can lose on credit spreads, all that kind of thing. Matt's point's good. Become educated. That's what Matt does for a living, I think, right? You educate people about options. So having said that, what do you think the most misunderstood, and we can even call it a Greek, but it's concept of the zero DTEs are for the retail folks, for the the average retail trader? I'm going to let you off the hook here. We're not going to talk about Row in this question. We're not going to talk about Vega. Those really don't exist in these two.
I agree.
We're left with delta, gamma, theta. We're not going to go into sub Greeks. We're going to keep it to the main one. So we got delta, gamma, theta as the ones that are left. Which one do you think the retail folks are really paying attention to, if at all, for that matter?
Well, I think if you're selling options, you're looking at the theta that you're.
Did you say harvest theta? Atta boy.
I think if you're looking at if you're a retail seller of options, you're probably looking at the theta that is on there. And if you are a buyer of options, you're probably looking at the gamma, because what you want from if you're buying these options, right, the time that comes out of these options supercharges all of those Greeks, right? It supercharges delta, gamma, and theta, basically. We're going to, like you said, we're going to toss out Vega and Rho. Those are longer term Greeks that really deal with options that have much more time in them. But if you think about it from the perspective of delta, right? In the money options, as time pulls out, in the money options tend toward 100 delta. They move toward 100 delta, and out of the money options move toward 0 delta. That's just a fact of the matter. And when you pull option time out of an option,
right,
their deltas, if they're in the money, start to increase. Their deltas, if they're out of the money, start to decrease. Now, gamma of options, if they are at the money options, as you pull time out, increases exponentially as you get closer to expiration. Gamma and theta are linked, right? And so if an option has more gamma, it naturally has more theta. That means that the actual theta of the option is increasing exponentially as you get closer to expiration as well. So when you are a retail trader and you're looking at this and your long options, you're probably looking at the gamma side of things, because the gamma is the net change of the option per $1 move in the underlying. That's going to tell you how much the delta of that option is going to change when the underlying moves, which means like my option just went from a 50 delta to a 70 delta, right? That means I'm either making or losing a lot of money in that regard, right?
Yep.
And then theta is commensurate with the amount of gamma that isn't intrinsic within that option. And as time comes out, as you get closer to expiration, the theta increases exponentially, because whatever extrinsic value that is left in that option has to come out before the end of the day, right? Like that option is going to 0. If it is out of the money, it is going to 0 at the end of the day. And so whatever value is left in it right now, if it's worth 40 cents, it has 40 cents that's going to come out by the end of the day, unless the underlying moves to the point where the delta changes, right? To the gamma makes the delta to the point where it's actually worth something intrinsically. Right. Always keep in mind, at the end of the day, options go to intrinsic value. All of the extrinsic value of an option goes away. Extrinsic value is implied vol and time, basically. That's all it is. And dividend risk and some other things, but that's like longer term stuff. So implied vol and time, as they come out, right, the extrinsic value of the option is going to 0. The intrinsic value of that option is what is going to be increasing as time goes on, as a relative percentage of the value of the option. And so when you're talking about retail traders, I think if they're long, they're looking at the gamma, and if they're short, they're looking at the theta.
Yeah, I agree with that. I think that makes sense. The other problem the retail people have is that in the money option that's running toward parity on expiration day, all that extrinsics coming out. They also have another issue. They have an issue of assignment, right? Yeah. And that's something that I've noticed that many retail folks don't want to have necessarily. Now, I know someone's gonna say, well, what about the cash secured put? I get that. They're willing to take that long stock if they get it put to them, because that's what they did in the first place, right? But generally they don't want to hold stock after expiration. So now all of a sudden they have another decision to make. They have to close that option out and roll it, right? Yep. Or close it out or roll it, one of the two. Yep. So they have to play that game as well. I think, these are all great points too, Matt. I love it. But I think, I've also seen some folks, some retail folks, they like to sell early and then harvest like harvest like by 11.
Wait,
right?
I'm gonna pour mine in my lid because we're just
Yeah,
gonna
there you go.
mix it up a little bit.
You have it.
But it's a very short
shot.
span, and they do this. Let's call it a put credit spread or a call credit spread, or combine them both into an iron condor, short iron condor. They'll do it early, and then they'll take 20 cents out of it and take it off. Now, I'm not making a prescription that that's a great strategy or not. I'm just saying that's what we see some of.
Right.
And it's interesting. I think it kind of works because of the whole, theta's running to zero, right? Or parity.
Always.
Yeah, it makes sense. I get it, but I think the other gamma risk can be severe, right? You could go to, getting wiped on that spread, go to total loss very quickly.
Yeah, I think there's another interesting element to this, which is, and I think one of your competitors made a good point. What is it called? Options Alpha, which is run by Kirk Duplessis.
Yep.
He does a ton of options education, and he recently wrote and did a podcast on essentially the fact that automation is here. And that automation from a trading perspective, if you are not doing it, you are theoretically falling behind right now. And the funny part about that is that most of the people that are using those defined outcome strategies that you were talking about, iron condors, things like that are doing it from a retail side, a lot of them are using an automated strategy to actually implement those kinds of things. And many of those are happening in these 0DTE SPX options, right? People are doing that because of the fact that what you mentioned before, which is if you happen to be short options in this place or this place or this place, you incur actual assignment risk. Well, guess where you don't have assignment risk? In a cash settled European option. Where do you find cash settled European options? In the SPX.
In
right?
Chicago.
In Chicago, baby.
Right?
Chicago. On the floor of the CBO.
That's a single listed product, that SPX.
Yes, that's true. I won't mention who actually lists it, but but that's right. That's one of those things that I think also needs to be built into this conversation eventually. And it's going to be is a facet of the conversation that becomes more and more prevalent as we go on, because much like the point I made earlier about the fact that, the exchanges list these options because they are where the volume is. They're not going to stop doing that. The other part of that conversation is the automation piece of this that exists out there. It's a genie in the bottle kind of vibe. You can't put that genie back in the bottle. It's like the AI conversation, right? All these people are like, we need to pause AI. And you're like, okay, well, that's great. How are we going to do that? Because if you ask someone to stop doing it, someone else is just going to build in their place. And that's exactly how this is going to go. I think from an options automation perspective, is that you're going to be dealing with this on a much, much more, prevalent basis, that the retail trader is increasingly going to be executing their strategies from a bot, from a retail bot that they've either paid for or that they've programmed themselves.
Sure. Are you sorry, Matt, I'm sorry to interrupt. So would you say for the retail person, are you a fan of the bot? I mean, do you like it? Is it something they have to compete, you think, or maybe not?
I'm not completely convinced that they need it to compete right now. Kirk Duplessis's point is that if you're not using it, you're falling behind right now because you have less edge in the marketplace. I'm more of the I don't know, things trade so close to fair value all the time that I'm not necessarily sure that you actually need a bot to do it. But his point is that the idea behind what's happening right now is that all of these different things are available to you all the time.
Sure.
And so when you have latency that is collapsing and the availability of any marketplace to trade at your fingertips, you are technically falling behind if you are not constantly placing your money in the most advantageous place for it to be, which means, maybe you should be short premium in gold right now because it's super high. Or maybe you should be, long soybean premium because it's super low. Well, his idea is that if you're using a bot, you have a better ability to move and, transfer your money into places where opportunity exists.
Right.
I'm kind of like, are people actually going to do that? I don't know. But his point, if you fast forward 5 to 10 years, I think is very valid.
Sure.
And at some point, I don't think that point is now, but at some point, yes, I think if you don't have some sort of automatic execution platform, you probably are going to be falling behind. I don't know if it's right now or not, but I'm also a trader that has a ton of experience trading options. And so from my perspective, I'm not sure that I would ever use a bot until I was in a position where I was like, I don't want to look at this. I don't want to execute this. I just want, to be long iron condors in whatever. Go, right? Hit the go button and put a bunch of money into it and let it go. But I don't know. What do you think?
Well, I was going to say, the value of a bot to me and again, I'm talking from the retail side, not as a market maker from my old days, is that it defines my workflow and my emotionless exit strategy. And for me, or to me, that is the most vital thing about automation. I think there's a good argument that can be made of getting into a trade for various reasons, and whatever retail people have to have reasons, right? Because they can't buy business all offers, so they have to have another edge parameter. So once you get into the thing, I think the biggest mistake I see retail folks make is some sort of lack of discipline. And where a bot takes that out of the equation is that you set it to exit the strategy based on something, and I'm not going to give you the holy grail of what that is. Once you set it, walk away. And then when it exits the strategy for either a profit or a loss, whatever the case may be, you're done. You can't argue about it. You move on. Now, if you're always losing, then maybe your exit strategy isn't very good. And you have to go back and recalibrate that baby. But that's something that takes, it's hard work. You put some statistics on a page, you do some analysis, you figure out, hey, am I making money on these things? So to me, that's where the bot's useful. Because I got to tell you, in the off-floor world, I was kind of bad at it in a way because I always wanted to intervene and, get out too early, let my losses run. That whole game, man. That's no good.
No.
So that's why I like bots, though. I do like that. And go ahead, Mal. Sorry.
No, go ahead.
No, I was going to say your earrings look unbelievable, by the way. You just turned
my marshmallow earrings. We're working on Monday. We have a whole new studio for you.
I think you got to get the dark ones every once in a while too that they gave me. I never used. So no, I think that part's really good about it. That whole emotionless exit. I haven't decided if the emotionless entry is worth it yet. I have to think about that one a little bit longer. I'm still studying.
I'm going to throw a Monday analogy out. Pre-AI, pre-bots, it's almost as if you're riding a horse, crossing the country, you're a pioneer, and you have to look at metrics like deltas, and you're looking at the weather and weather patterns and the stars and you name it. And so when technology comes along, you get to sit in a Tesla, you get to sit in a car, put your GPS on, and really start to value trade, really start to decide where it is that you want to go and why. And so I think it might also change how we trade. And I think it's really great for value traders too, where someone who, I think Steve Jobs, when he came out when he was explaining his new type of computing, he said it's for the average guy who doesn't want to learn, who just wants to jump out. And I'm talking to an educator, but imagine you have this technology backing you and someone really loves a company. They just want to get in. They know they have to hedge inflation. So how do they do that? And this technology starts to marry. And so now I am going to throw you a curveball. So what is your position on the SEC's push to 2020 best interest?
Hold on a second.
Oh my God, Molly.
I just passed out.
I'm just curious, Matt.
Yeah, go ahead, Matt. Take that one.
What do you think?
Always seem to include the SEC, which is like, from my perspective, anytime someone mentions the SEC or the CFTC, I start to kind of go like this.
All of a sudden, I squirm my seat. I'm like, ooh.
Okay.
It's like we're at a house party and we're talking, dad and mom are coming home.
Yeah,
It
exactly.
feels like talking parents.
So what's your question about the SEC's view on what?
No, I didn't mention SEC, did I? I didn't ask that question.
Oh man, I love it.
Oh, Mal. Hey, Matt, by the way,
There was a question in there somewhere, Molly.
I
What
don't
was the
think there was. I just
Okay,
thought your
fine.
shirt looked so nice. I just wanted to tell you
do
your
you
shirt
know,
looks
do you
so
know what I
great.
just noticed as well? As I'm leaning up toward the screen now, and I
Yes.
noticed that Matt has
I'm
this
gonna
little
lean in.
Zen candle in the background.
Oh yeah, have you seen that
I,
before?
I see the Zen candle. I just noticed. I'm like, wow, he is such a Zen master. That's unbelievable.
There's also that's a Ganesh or Ganesh, which is the remover of obstacles.
Oh,
He removes
Amazing.
wow.
He sits back there and just removes obstacles from my life.
Very Zen-like.
I love that. I'd like to know why Shiva is in front of CERN. Since we're on the topic.
I don't have Shiva in my trading room for sure.
All right. Well, we're going over today. So last thoughts on zero DT, Matt, for now. We'll tee this up again in a future show. I'm going to keep looking at the stats. I think Mandy's piece is really good. I want to see the full report too. That's available. I'm going to read that.
Yeah.
But any last thoughts on this baby?
Let me just say a couple things.
Yep.
The first thing is always I may sound like a broken record and like I'm talking my own book, but especially when you're dealing with options like this, it's important to do some real thinking about what your risk is.
Right.
And what you're thinking when you're thinking about what your risk is, the real basis of that is going to be building some real solid base of knowledge around optionality, because optionality is what is underneath all of these trades. And if you understand the inherent optionality and how it works, you can apply it to everything. And that's the real important piece here, is understanding how the optionality works and then applying it to all of these different scenarios, especially when they start to align with what you think is going to happen.
Mm-hmm.
And so that's the real important part from my perspective. Understand how options work, do some work, and understand how they actually work, the math behind them, and you'll be much better off when you walk into a room and start pressing buttons and buying or selling options.
Yeah. I
That's all
thought you were going to say. Go ahead, sorry.
Practice virtually.
Yeah.
Don't play with Monopoly money first.
Yes, there's
Not
so
too
many
long
people.
though.
Yeah.
I don't like playing with Monopoly money too long. You think you're good at it, and then you're really not. You're only good at something when you do it for real.
When the skin's in the game.
Well, those are the best lessons to learn, right? The lessons that you learn the best are the ones that cost the most money.
Yeah.
But
I thought you were going to say
paper trading is a great idea, right?
Yeah, it's good. It's good for up to a point. I agree with that. I thought you were going to give me like the old cocktail party sort of equation of zero DT when you're at a cocktail party, and I thought you were going to say, "Here's what you got to say" or something. I'm like, wow, he's going to give me the cocktail party.
No,
comment.
No.
Dang.
I'm not doing that. I'm gonna tell you that you need to learn how options work before you trade zero DTE options.
That's a good point. Always, I love it.
Exactly.
All right, Matt, we're gonna let you get back to your day. Thanks for coming on as always. You're the best. I love the sensei look back there. I hope you feel better.
Remover of obstacles. He's currently removing obstacles as we
and right now the obstacle is Molly and me letting you get to your day. So he's going to remove us right now.
Yeah, and it successfully wouldn't allow me to ask my question. It works. It works.
I love it.
It just got blocked.
All right.
All right, Matt. We'll talk to you, man. Thanks for coming on. Appreciate it. Miles, see you soon.
Thanks, Matt.
All right, that's a wrap. See you guys.
Bye, Matt.